What's the difference between index funds, mutual funds, and ETFs? You know, some financial gurus out there, like Dave Ramsey, doesn't like ETFs. But does that mean we shouldn't invest in ETFs because Dave Ramsey says so? Well, no. You know, there are so many different things out there that these can be just a bit confusing. So in today's video, we're going to be talking about index funds, mutual funds, and ETFs. We're going to try to see which one is the best for you. Hey guys, my name is Steve, and I try to help people to save more and invest better. That's just what this channel is for. So if you like this type of content, make sure to smash that like button and subscribe, and we'll continue to create great content to help you to do better. All right, let's get to it because, you know, time's a wasted. All right. Now, our first one we're going to talk about is mutual funds, and the reason we talk about it is because it is the oldest of these three. Now, a mutual fund is one of the things that most people kind of talk about. It is a group of different stocks that come together and people put in their money to kind of buy this one fund. Now, the great thing about this is, first of all, it is convenient. Now, the reason I say it's convenient is because, you know, when we're looking and trying to create our portfolio, we may want to pick A, B, C, D, E, F, G stock, and it could be kind of mind-blowing. We may get a little burned out of looking at the information, but if we buy a mutual fund that's got all of these into it, well, you can just buy one and kind of buy and hold forever and just continue to buy and buy and buy, and that's just about it. You know, it just makes everything convenient. And most mutual funds have anywhere between 50 to maybe even 1,000 different stocks. And so this gives you an opportunity to own lots and lots of pieces of different companies. And that comes up to kind of our next point is mutual funds are diverse. They have a lot of diversification within these mutual funds. Now that means if, let's say, you have one stock and it kind of crashes and goes crazy and you think it will plummet your portfolio, well, no, not if you have 50 to 100 different other stocks keeping the entire fund up and rising. Now that is great news to you because, you know, if you had your own portfolio of 50 to 100 different stocks, or maybe even 5 to 10, and one of your biggest holdings crashes and burns, you know, that could just crash and burn your portfolio and you could have some heart palpitations, and that's just not good. So that's why a good mutual fund is kind of convenient and diverse. And the next point that a lot of people like is that it is managed professionally. Now, there are a lot of different types of mutual funds, and most of them are managed professionally. Now, what that means is you have someone that's studied, gone to school, looked up, figured out which stocks they want to put in that basket full of stocks for your for your mutual fund, and they will allow you to kind of keep going, and you don't have to worry about it. It is professionally created for the individual. Now, the problem with kind of these professionals is not all of them are the same. Some are good. Some are not so good. Some charge lots of high fees, and that could kind of empty out your pocket. Now, these mutual funds, these managed mutual funds, have high fees of anywhere from 0.5% all the way to 2%. And if you think about 2%, that's $10,000 times 2% is $200. And they will take this even if your money goes up or down. So that is a problem with that. Now, in 1975, a guy named John Bogle, or Jack Bogle, like some people like to call him, created the first index fund. Now, an index fund is a mutual fund, but it's passively managed and it follows an index. So an index could be like the S&P 500, which tracks the top 500 companies in the US. It could be the Dow Jones. It could be maybe the NASDAQ or other different indexes. So what's the difference between a index fund and a mutual fund? Well, all index funds are mutual funds. Good. So it's like a basket full of different stocks and it's diverse. But the thing that's different is it is not professionally managed. It's passively managed. It just tracks an index. So if you wanted to buy maybe a fund that tracks the S&P 500, there are many different funds out there. Vanguard has VFIAX, and Schwab has SWPPX. And those are two different S&P 500 index funds. And the great thing about them is they are low cost. So the Vanguard VFIAX costs about 0.04%. So that's about $4 for every $10,000 invested. See, $4 is a lot less than $200. Now you may be wondering, why should I pick an index fund versus a managed fund? Because managers should know what they're doing. They're great. Yeah, there was one great fund manager named Peter Lynch. He ran the Fidelity Magellan Fund from 1977 to 1990, and he averaged about 29%. So why can't we find those guys? Well, some of those guys are kind of diamonds in the rough. First of all, Peter Lynch was doing really well, but not everyone was investing at that time. When he was kind of making the markets, kind of making the news, people started investing, and at that point, the Magellan Fund was kind of going a little bit down, and so those people usually were trying to get at when it was at the top, and they were losing money at the end. Now that happens with some professional managers. Now Warren Buffett, one of the best investors of all time, decided to bet a hedge fund manager to see which one is the best. A hedge fund manager's professionally managed fund, or a simple index fund by Vanguard that tracks the S&P 500. Now, you know who's gonna win? Well, I'm gonna tell you the story. So this bet started, it was a 10-year bet worth about $1 million, and it started in 2008. And we all know what happened in 2008. So the hedge fund manager started winning. But then what happened was the S&P 500 started to go up after the crash. And by 2016, he took a measurement. The index fund by Warren Buffett, tracking the S&P 500, was averaging about 7.1% real returns, so that's minus inflation. And the hedge fund was doing 2.2% per year and costing those people about 2% on top of that. So let me know what you think would have been the best. Well, to me, I would have taken the cheaper one and the one making the most money, which was the index fund. So there you have it. Why we should choose maybe the index fund, because it's low cost, and over the long term, it's going to beat professionals in the long term. Now, if you're thinking, well, why don't I just invest in index funds? Well, you have your third one, which is called the ETF, or the Exchange Traded Fund. Now, the difference between an ETF and a mutual fund is the ETF is an exchange traded fund, so it is like an index fund or a mutual fund, but it is traded on the stock market like a stock. So stocks are traded, and you see they go up and down. People buy and sell. And at the end of the day is when the mutual funds are kind of bought and sold. So an ETF, it's like a stock, but it's traded like a stock, and it's more like a mutual fund, but traded like a stock. Now, some people may not like ETFs because it incentivizes maybe that gambling kind of people. People want to trade, buy and sell. But to me, I think it is a useful tool for those people that may not have the money or capabilities to get into index funds. The problem with Vanguard index funds, now I'm saying Vanguard, not Fidelity or Schwab, is there is a high entrance to get into. Now, VTSEX, which is one of the best index funds on the market, tracks the total stock market index fund, and it's great. Costs $3,000 to get into it. Now, not everybody is sitting with $3,000 on hand to get into an index fund. So, do they have to sit and wait? No. You could buy VTI, which is the ETF of VTSEX. VTI has a cheaper expense ratio, same portfolio, and it costs right now maybe $270 to get into. And you may be thinking, oh, what if I don't have $270? Well, here's the next thing. You can buy it using a fractional share. If you have $100, you can buy $100 worth of VTI on Vanguard, on Fidelity, or in M1 Finance. ETFs can move from place to place, and you can buy fractional shares with them, and that's one of the best things about ETFs. It is a low barrier to get into. Two of my favorite ETFs is SCHD by Schwab, which is a high dividend ETF, and SCHG, which is a growth ETF by Schwab. They cost about $28 to $38 each, and it's so easy for people to get into those ETFs because they have a low barrier. If you only have $10 and you can buy a fractional share of that, well then boom, you got it. And these are the reasons I like ETFs. Now, I just explained some mutual funds, some index funds, and some ETFs kind of quickly. I hope you enjoyed a little bit about that, and I want to know, what is your favorite type? Personally, for me, it's ETFs, but I'm willing to bet someone is going to disagree with me, so leave that in your comments, and let's start a conversation. All right, I hope you guys have a great rest of the week, and I'll see you guys later.